When we think about what keeps a country moving, literally, fuel is at the heart of it. And in the Philippines, one name stands above the rest: Petron, more than just a fuel provider. Happy February, and you are watching Bini Consulting Group, bringing you the latest recommendations for stocks of Petron Corporation. With a closing price of 2 pesos and 36 centavos as of January 31, 2025, Bini expects Petron to reach a target price of 3 pesos and 96 centavos, a 68% upside. Given this, Bini issues a hold recommendation for the stock. The stock price rise and fall based on a complex mix of market forces and industry challenges, internal strength and operational challenges, and financial performance. With this report, we'll take a closer look at our 3 predicated recommendation points. Stock prices respond to powerful economic and market dynamics. For Petron, these forces include global oil pricing volatility, competitive landscape, the regulatory environment, Philippine GDP, market demand, and supply. This report provides a comprehensive summary using pestle analysis and Porter's 5 forces. For political, changes in regulatory frameworks or taxes could significantly influence profitability. The entry of imported fuel and increased competition challenges Petron's market dominance. Global crude oil prices supply chains are also influenced by international political events such as sanctions or conflict in oil-producing nations. Economic. In 2023, Petron's net income surged by 51% to 10.1 billion, despite a 7% decline in revenues caused by lower average crude prices. This is due to a sharp increase in jet fuel and LPG sales. CAGR of petroleum production in the Philippines from 2020 to 2023 has grown at a compound annual growth rate of 14% and oil consumption at 7%. According to the 2024 report from the International Energy Agency, demand growth is slowing, driven by clean energy technologies and electric vehicles. There are emerging Asian economies, particularly China and India, driving demand growth, while oil demand in advanced economies is projected to decline sharply. There is a rising global oil production led by non-OPEC producers, which is expected to exceed demand from 2025 onwards, potentially putting downward pressure on prices. Finally, Philippine GDP is expected to grow at 6%. Social. Post-pandemic recovery has driven higher consumption for jet fuel and LPG. There is an indication of growing interest among Filipinos in electric vehicles, with factors such as environmental concerns and many more. For technological, as the only oil refiner in the Philippines, Petron's ability to optimize refining technology remains essential. Increased sales in LPG and aviation fuel suggest an opportunity for Petron. Philippine Institute of Development Studies highlight electric vehicles are more practical option for daily use. For legal, there are revisions to excise duties and fuel taxes by the government that could affect directly Petron's pricing and profitability. Expanded import duty exceptions to include multiple electric vehicles until 2028 are making these more financially accessible to consumers. Environmental. The global push towards renewable energy and sustainable practices challenges Petron to innovate and diversify to reduce reliance on fossil fuels. Finally, according to the International Energy Agency, more than 75% of global demand growth from 2023 to 2030 will be captured by alternative fuel sources. Let's analyze how these key economic and market dynamics impact Petron using Porter's 5 forces. First, threat of new entrants moderate. This is due to high capital requirement in this industry, a heavily regulated nature of the petroleum industry, fuel pricing policies, and environmental laws. Second, bargaining power of suppliers, high. Petron relies on global crude oil markets, which are influenced by geopolitical risks, OPEC decisions, and supply-demand dynamics. Third, bargaining power of buyers, moderate to high. Fuel is a commodity and consumers are price sensitive. A growing interest in electric vehicles and alternative fuel reduces consumer dependence on traditional petroleum products. Fourth, threat of substitutes increasing. Government incentives expanding electric vehicles infrastructures, investments in solar and wind, creation of potential substitutes for fossil fuel-based energy consumption pose a long-term threat to petroleum demand. Lastly, industrial rivalry, high. While Petron holds the largest market share in the Philippines, they are still competing with other oil companies. The Philippine oil industry is dominated by three major players: Petron, Shell Pilipinas, and Chevron Philippines, collectively known as the Big Three. Together, they account for about half of the market, with Petron leading at 23% of total petroleum products in 2023. Petron also operates the country's last remaining oil refinery in Bataan, supplying around 40% of the nation's fuel needs. Meanwhile, Shell and Chevron have shifted to purely import-based operations after closing their refineries.
Following the macroeconomic analysis, we now turn to Petron Corporation's internal assessment. Petron is the sole oil refining and marketing company in the Philippines with operations extending in Malaysia. Petron was established in 1966 as Esso Philippines before rebranding as Petron Corporation in 1988. It is majority owned by San Miguel Corporation and is publicly traded on the Philippine Stock Exchange. Operating an integrated refining and distribution model, Petron refines and markets petroleum products catering to retail consumers, industrial clients, and government sectors. Petron operates two key refining assets. First, the Petron Bataan Refinery, the only refinery in the Philippines. It has 180,000 barrels per day capacity and supplies 40% of the nation's fuel demand. Second is the Port Dickson Refinery in Malaysia with 88,000 barrels per day capacity and ranks third in Malaysia's retail fuel market. These refineries provide a competitive advantage over import-dependent players, allowing Petron to optimize costs and supply stability. Petron's long-term vision is an energy-secure and prosperous nation where everyone's journey is fueled by meaningful experiences and sustainable success. To achieve this, the company focuses on maximizing refining, distribution, and retail infrastructure, enhancing customer experience through innovation and digital transformation, and lastly, expanding sustainability initiatives to align with global environmental standards. This vision underscores Petron's commitment to energy security, operational efficiency, and sustainability leadership. Petron generates revenue from multiple business segments. First, from retail and commercial fuel sales. Petron operates more than 1,900 stations in the Philippines and 750 plus stations in Malaysia. Next revenue source is LPG distribution for residential and commercial use. Third is industrial and wholesale fuel sales for industries such as power plants, mining, and logistics. Fourth is aviation fuel and lubricant sales for major airlines in the Philippines and Malaysia. Next is sales from petrochemicals, and lastly, revenues from its non-fuel business, which includes the Petron Treats convenience stores and fleet cards. Although Petron's diversified revenue base ensures stability, its margins remain vulnerable to oil price volatility and market fluctuations. Petron's operations is supported by key subsidiaries. Philippines-based subsidiaries are NVRC, which manages land leasing for fuel stations, PFC, which oversees duty-free fuel imports, PMC focuses on branding and retail operations, and Mema Holdings Inc. in charge of hauling and logistics. Petron's international subsidiaries are Petron Malaysia for the retail and refining operations, Petron Singapore Trading, which handles crude procurement and trading, PGL and Petron Finance, which are financial holding and investment entities, and Petrochemical Asia. These subsidiaries reinforce Petron's regional growth strategy and supply chain integration. Petron's strategic initiatives center on retail expansion, refinery optimization, digital transformation, and sustainability. For retail expansion and innovation, Petron plans to increase gas stations and convenience stores in the Philippines and Malaysia. The company also plans to introduce EV charging stations as an early step toward renewable transition. Petron's strategic focus includes investing in refinery upgrades to meet Euro 5 fuel standards and improve cost efficiency. For digitalization and customer engagement, Petron is expanding Pima's loyalty app to drive customer retention and will be implementing automated fleet management systems for corporate clients. For its sustainability and green energy initiatives, the company is investing in carbon capture, biofuel blending, and solar energy. Petron is also active in biodiversity programs and ensuring compliance in sustainability reporting. These initiatives ensure Petron's long-term competitiveness and adaptability in the evolving energy market.
On our financial analysis, Petron continues to demonstrate financial stability despite industry volatility. Over the next 5 years, we expect the company to generate substantial revenues. However, given its reliance on the petroleum segment, revenue growth will remain highly sensitive to fluctuations in global oil prices, consistent with its historical performance. In terms of profitability, Petron is expected to sustain stable margins throughout the forecast period. The company has strategically invested in operational efficiency, reinforcing its position as a cost leader and strengthening its competitive advantage. On the balance sheet side, while Petron operates in a capital-intensive industry with significant debt exposure, it has consistently proven its resilience. Liquidity remains a key consideration, with current ratios expected to stay above 1.0 times, though still in a tight position. However, its debt-to-equity ratio is projected to decline in the coming years, reflecting improved leverage and financial discipline through stable, profitable operations.
The valuation assumptions we've used are as follows. The risk-free rate is the annualized yield on 10-year bonds sourced from worldgovernmentbonds.com. Equity risk premium was sourced from Damadaran's 2025 estimates of the Philippine market. As Petron Corp was not explicit about their equity beta values, for the purpose of this forecast, the equity beta was calculated utilizing the monthly closing prices for Petron Corp and the All Shares Index for the last 5 years. From this, the unlevered or asset beta was calculated using Hamada's equation. The tax rate we've incorporated is the Philippine corporate income tax rate of 25%. For our assumption on the long-term FCF growth rate, we've compared the 3-year FCF growth rates of Philippine-based peers in the same industry. Petron Corp, along with Shell and Phoenix, all have growth rates of 0. For our estimates, we've specified a long-term FCF growth rate of 0.005%, given Petron's and the industry's outlook iterated in this presentation. A peer multiple analysis between Petron and Shell can help us understand Petron's standing in the Philippine petroleum industry. The ratios specified in the succeeding slides were sourced from both companies' latest disclosures. When compared to Shell, Petron is generally undervalued. Considering its lower price to earnings and price to sales ratios, This is an indicator of Petron being of better value to potential investors. A point of consideration, however, is Petron's higher debt to enterprise value ratio, which points to some concerns of financial risk. Considering profitability, Petron outperformed Shell. The former has higher operating and net margins, along with higher returns of equity. This indicates that Petron is better at managing its costs and can generate more value for its shareholders in terms of profit. Shell, however, is more efficient in collecting its receivables and utilizing its assets, meaning that Shell can generate more revenue per unit of asset and collect payments at a faster rate than Petron. In terms of capitalization, between the two, it can be considered that Shell has a stronger financial structure that is not dependent on debt. Petron is significantly leveraged, meaning that its financial risk is higher. Petron, however, is slightly more liquid than Shell. It has a higher current and quick ratio, meaning that it has better capacity to cover short-term obligations. In summary, between Petron and Shell, Petron is more profitable and is of better value to potential investors. Petron is a viable choice for investors that are comfortable with higher levels of risk and favor growth and higher returns. Considering our forecast assumptions iterated earlier, this brings us to our recommendation. From Petron's current price of 2.36 pesos as of January 31, 2025, we forecast the intrinsic price to be 3.96 pesos. For Petron's current stockholders, we would advise a hold position. Petron has exhibited a stable cash flow operations-wise and has maintained its market position over the last consecutive years. The high debt levels, however, do pose a point of concern. For new investors seeking to purchase Petron Corp stock, we would advise to purchase with caution. Though Petron's reliable potential for growth and strong market share appear attractive, it is necessary to be conscious of Petron Corp's level of exposure to debt and its price dependency on the fluctuation of crude oil prices. In behalf of the Bini Consulting Group, we hope you found this presentation informative and that the insights you gained can help you make the best investment decision possible. Thank you.